kick off with an overall view on the market direction right now. Of course, two big risk events globally is the non-farm payrolls data from the US out on Friday, and of course, whether Greece will be able to secure that debt swap deal with creditors to ensure that it avoids a messy default. How does this play into sentiment and the direction of the local Nigerian stock market?
Okay, thank you very much, Samantha. We've seen some increase in the level of optimism in the Eurozone market. We've seen approval for Greek, the second bailout for Greece rather. We expect this to have a positive impact on the Nigerian market because we expect foreign investors who currently account for around over 70% of activities in the Nigerian bourse to develop a lot more interest in Nigerian equities as they are currently. We would expect increased participation. We would expect increased confidence in the Nigerian market, and because liquidity will no longer be a factor for them over there, we would expect them to take more risk in the Nigerian market, and that should play out positive for them going forward.
Let's focus in on the banking sector because, of course, that is an area that you look at specifically. Access Bank has been an outperformer year to date, up almost 50%, but falling back by 2.7% on the day yesterday. What's driving the share price higher, and do you believe that it has further to rally right now? And, of course, we know that it has announced that it's further ahead with its plans to merge with Intercontinental right now.
I think the market is pricing in early enough the expected synergies from the tie-up of Access Bank with Intercontinental Bank. You recall that the bank had earlier on given indication that it would operate Intercontinental Bank as a subsidiary within a window of 3 to 6 months to try and gauge the likelihood of any crystallization of execution risk as far as the transaction is concerned. There are indications that right now, that the bank has actually fast-tracked and actually done the integration faster than earlier expected. And I think the market is recognizing that the expected synergy is so enormous. Intercontinental Bank comes to place Access Bank within the top 4 ranking in the Nigerian banking space. And that is a lot of benefit for the bank. It's an opportunity for the bank to drastically reduce its cost of fund. And I think investors are pricing that currently into the stock price.
There's a lot of the divergent views in terms of how long the restructuring will start to take to start bearing fruit for the emerging banks. In your view, though, for Access and Intercontinental specifically, what type of challenges do you foresee in terms of the restructuring challenges that they're going through, and of course the cultural integration between the two banks?
Yeah, I think there are no major challenges in my view. If you watch last few days, we've seen the integration of the IT platforms of both banks done with some measure of ease. I think that is a positive development for the bank. In terms of cultural integration of the staff of both banks, at some point in time, we've had staff of Intercontinental Bank having some level of participation in the decision making of Access Bank, and we have already seen some of Access Bank staff actually having some level of participation in the operations of Intercontinental Bank in the past. So in terms of cultural integration and execution risk, I do not foresee significant downside from that perspective.
Further down the ladder in terms of size, we've got Diamond Bank, which has also been one of the top performers this year, up 33% year to date. Of course, we're still expecting results out of most of the banking sector, but in terms of provisioning for Diamond Bank, that has been highlighted as a key factor that's going to weigh down on full year results. What type of provisioning are you expecting in Q4, and what impact is that going to have on earnings?
Yes, we're thinking also that Diamond Bank haven't given earlier indication that they were going to take provisionings of up to 35 billion naira for 2011. And as at Q3, they had already taken close to 25 billion of that. Even though we expect at the end of the year, we expect them to be able to take at least 38 billion naira in provisioning. And with an operating profit of around 35 billion, based on our forecast, we expect the bank to, best case scenario, to come up with a loss position. However, we expect it to be minimal. We have already seen the market looking at the clean state of the bank and the operating profitability of the bank and pricing that into the stock price. And I think that is a positive development for the bank, and the market will expect to see improved momentum going forward into 2012 and 2013.
So best case scenario is that earnings will come out flat, but going into this year, they're looking at growing their loan book by around 30%. Yes. That's an aggressive target. How achievable is that this year?
Yeah, I think that is quite achievable. We saw a very high level of momentum in Q3 loan book, growing by as much as up to close to 20%. The bank had given indication that they want to improve on that, and we believe that is very possible. Even though you tend to question the intensity of the growth in that loan book, from historical evidence, we've seen that the retail banking space, even though it is underpenetrated in Nigeria, it is at the same time, it is very risky. But we like the fact that the bank is concentrating a large chunk of his loan book in lower maturity. About 33% or 35% of his loan book actually has maturity greater than a year. And I think that is a very good mitigation for the likely risk that the bank would be facing in that retail space.
So does that dampen risk, basically? Does that put water on some of the risk around lending to the retail space?
Yes, I think the most important thing is the risk management practice of the bank. I think that is robust enough. We have confidence in that. We expect the bank to be able to spot any major crime. And because it is concentrated on the retail space, we expect the bank to be able to drive their loan book and reduce their cost of funds significantly going forward.